Welcome to Between Two Chairs, Demystifying Commercial Real Estate, the podcast that brings you the latest insights and trends on the South Florida commercial real estate market, with your hosts, Fernando Arencibia Jr. and Jennifer Woolman. In each episode, we dive into the world of commercial real estate and break down complex concepts to make them accessible for everyone. Whether you're a real estate professional, a curious investor, or just interested in the South Florida market in general, Between Two Chairs is the podcast for you. So pull up a chair and join us.
Welcome, everybody, to another episode, a very special episode of Between Two Chairs. We have a very dynamic guest. I just can't wait. So we're going to jump right in. But as always, my name is Fernando Arencibia, and with me is the amazing, illustrious Jennifer Woolman. Hi, Jennifer. Say hi.
Hi. I think you're going to have to keep using more words. You keep having to come up with creative
I know.
words.
They're all an offshoot of amazing. So there you go.
So we're super excited with our special guest today. It is Scholastica Cororaton. She is the chief economist for the Miami Realtors, and she is also a statistician. Say that 3 times fast. I can't even say it once correctly. She was the senior economist for director of housing and commercial research for NAR. She's a statistics graduate teaching assistant at George Mason University. She has a ton of experience, great information, and what we love about Gay at the association is she takes data and information and just breaks it down into such easy to understand and read in very bite-sized pieces, because sometimes, people say economist and your eyes kind of start to glaze over, like if you remember your micro and macro econ from college, and Gay is definitely not that. She's wonderful with the information she presents, especially on a local level. So today we're going to dive right in, and I know we kind of want to compare the national overview versus what we're seeing on a local level in Southeast Florida. And that's what we're going to focus on today.
Welcome, Gay.
Thank you. Glad to be here. And Jennifer, that was the best introduction. To be introduced as someone who's able to break down the data, that's terrific. That's really my objective. Yeah, I don't want to be too high up there, but at the same time, I want to present the data and, not to dump it too much down to our readers, because, you got to understand economic concepts. But thank you so much for that great introduction. I love it.
It's our pleasure. So before we dive into the numbers, tell us a little bit about yourself.
Yeah, so as you said, I'm an economics and statistics graduate, but really I'm an economist. I came from the Philippines sometime 2005, but I've got a history here. We were here in the 80s, a little bit of personal background. So my eldest daughter was born here. So we lived in Massachusetts, and then after a year, we moved to New York, and then came back to the Philippines. And when my daughter, who was born here, which makes her a U.S. citizen, got into I'll say the school, I'm very proud, got into Penn, the Wharton School, we came back here. And so, so we were in Massachusetts, New York, Washington, D.C., and I said to myself, wow, we're moving south and south and south. And so now I'm with Florida Realtors. So yeah, very happy. So I did work for 10 years at NAR, and it's just great to be working with Miami Realtors. And you guys, I want to thank you. You were the when I started doing commercial at NAR, you were the folks that I met, right? You were the leaders at that time. Jennifer, you, who else? Michael Hinton, Shepe. And so when you guys brought me over to Miami Realtors, I'm like, yes, it's just wonderful to know you folks. To me, when I work with a company, I like to have that relationship, and And so when I was offered that position, I said, yes, I know these people. I love them.
That's wonderful. We couldn't be more excited to have you here in this market and at such a dynamic time in the history of South Florida. And we've always enjoyed your perspective, and I think that an economist has to be able to share a point of view of how they see the marketplace and to put it in a way in which the practitioner, in our case, is able to really utilize it well, and it's able to inform not only their decisions for their business, but more importantly, the decisions of the people that we serve. I'm wondering, how has that experience been like to go from looking at the data from a national level to then be, having to be so hyper local and drill down into the data in a market such as ours?
So the methodology, as you would call it, perhaps, right? The framework is the same. You look at the fundamentals driving the real estate market. You look at job growth. You look at migration. You look at demographics. So that kind of framework is the same, but I enjoy applying that at the local level. And of course, learning about, the local neighborhoods. I gotta zoom in more at the city level, the zip code level. And I think also Florida, in a sense, and especially South Florida and the Miami-Dade area, it's a unique market. When I look at it, I'm amazed, at least for the housing sector, right? Higher cash sales than national, a luxury market. You've got and I'll discuss the statistics later, but you've got an office market that's somehow been resilient relative to the national economy. So it's different. And I'm learning, and I'm trying to learn that. And as I came here before the show, I'm like, yes, I know the data, but I got to see exactly where this store is that was sold. What this industrial place looks like. I love looking at the local market. And as you said, we're in an exciting time. And when people say, hey, where do you work now? And I say Miami, Florida, is like, wow, that's an interesting market, right? So, just lots of stuff. And of course, we know it's a challenging time. I think right now the challenge for me is it's a challenging time. And so you want to give information to our members and to regular buyers and sellers of how to navigate that market. So I don't want to drill too much on the negative anymore, but at the same time, I think the challenge for me also is I don't also want to say, hey, look through rose-colored glasses, like, hey, everything is going to be 100% perfect. Because if something happens, you'll say, well, why weren't we told, right? Like the Great Recession, right? Things were just going, great, and then the market crashes. I'm not comparing this year to the Great Recession. I'm just saying that for me as an economist, I want to give the data. My analysis is always data-based, data-driven, but I try to look for the opportunities and what can be done, to make use of that information. So you move forward, just move forward. The market keeps moving forward. It's going through cycles, but how do you kind of see what's ahead so that you also plan it?
So just to reiterate, it's definitely not the great financial crisis, which was definitely more of a real estate crisis. This is pretty much an interest rate induced issue, right? And once that's stabilized, we always say, the market doesn't like uncertainty. Yeah. But to your point, I'm going to quote from your first quarter 2024 commercial report. Even in Miami-Dade, who's been doing much better than national, sales of commercial real estate is down 6.6% from the same quarter in 2023. It's a slower rate of decline, but still a decline. And I think part of the issue is that everybody thought that we would see interest rates low or start to decrease a little bit faster than they have, but inflation is still being extremely stubborn. So can you tell us a little bit about that, right? How the Fed's interest rates are really what's driving versus the quality of real estate overall?
Yes. interest rates just ramped up so quickly. The Fed started raising interest rates in March of 2022, and they ramped up 11 times through July of 2023. So within a year, those interest rates doubled. So there was, a shock to the system. If you had, rates of 3% or 10 years ago, right? So commercial rates, they're set 10 years ago. When you refinance those, you're just going to have a more difficult time. You have to put in more equity. So it was just a shock, in a sense, to the commercial markets. And it's affecting their ability to put up that cash also, because lending institutions are also pulling back. The CMBS loans have declined. And the Fed yesterday just met, and Chair Powell said, well, we can't say when we're going to start cutting our interest rates. So people had thought that, as you said, it's going to be early in the year. And I had forecasted initially 5.75 this year, and then I revised my forecast early in January. Then I said 6.5%. But yesterday's meeting, inflation has just been so stubborn, and mainly because while rents, multifamily asking rents have gone down, it just takes some time for those rate declines to show up in the inflation rate. The Fed just really wants to be comfortable. And as the Fed says, they want to see more evidence that inflation is going down to 2%. So it will go down, but probably it could be later next year when they might hit their target. I'm not the Fed. The Fed isn't even saying that. So now, 10-year rates are now at 4.6%. So still some high interest uncertainty there. And the office market is the one that's really been hit. I think there was a track report that said half of the loans that do default are really just at maturity. They can't refinance. And in the multifamily market, asking rents have also started to fall. So you're being squeezed from both a lower pace of rent growth or even decline in some markets. And then on the cost side, you have your high cost of borrowing. And of course, that cost of borrowing is also affecting values, which means that when you refinance your maturing loan, you also have to put in more equity. So just a lot of pressure still on the commercial market, especially the office market. But, there's always a property there, right, where that will pencil out, so there's always a deal there, depending, of course, on the type of the property, on the location. There's always a deal there, and it just takes more hard work for the buyer, for the seller, for the investor to find out where those deals are.
So let's talk about that, because you did say that while total commercial real estate sales fell 6.6%, core commercial real estate sales actually rose 15% in the first quarter. Can you tell us a little bit about how both of those can be true?
Yes. Well, our report for commercial tracks about 23 properties. When you talk of commercial here in this report, talking of the core commercial, which will be your office, multifamily, industrial, retail, the core four, and of course there's hospitality, but there's also land sales. So vacant residential land, commercial land, vacant even agricultural land. And then there's the specialty commercial buildings. You're a mixed use. Several years ago, there was a golf area that was sold. So we're counting that. But essentially, when we talk of commercial here, it's really your core and then your land sales. So the core commercial real estate, that rose 15%. And if I break that down, there was almost a doubling of real estate sales. Industrial also rose off 20%, office 6%. Now, multifamily went down. And then when you talk of land sales, vacant industrial, vacant commercial, and vacant residential land sales fell, but your industrial sales rose. So right now, in summary, it's the industrial market that's really picking up.
It's interesting because you mentioned something earlier, and I think that is very true, which is that every time that you put out a piece of information, that it has to be grounded on the data, and opportunity is in the eye of the beholder, right? If you have the right data, right? So where some people might find not the right time or not the right opportunity, there are other investors that are going to see opportunity in those challenging times or when there is ever a shift in the market. I think that for a long time in Miami, we've been talking about industrial and multifamily being the two darlings of the investors for commercial real estate. But something really interesting I noticed in the first quarter of this year on your report is that at the top of the list of those four asset classes was retail. Retail saw a huge increase, not only sales volume, but you're seeing it in the increases in asking rates. You have a very low vacancy factor, half of the national average. And it seems to be that retail has really made a huge impact in first quarter numbers of this year.
That's right. So retail was up, and I looked at the number of transactions. First quarter of last year, I think we had about 43 transactions. This year we have about 63. So retail picked up, and I think retail is related to the demographics, right, and jobs, people moving in, jobs growing. In some other reports that I do, I think you mentioned it in one of your Between Two Chairs episode. I also create a report, a job and wages report every quarter, and there you saw an increase in job growth faster than the national average. I think Miami-Dade County is growing about 2%. Nationally, is just about 0.6%. You got a rising population growth. We know, of course, that the pandemic kind of really decimated international migration. So that is back up. Miami-Dade, again, is the number one county for net international migration. Population is rising. We also track, and this is another piece of data that I'd like to mention again, and I think we're getting some really good traction about this data in the news. Driver's license exchange data. So we use that to track migration. And again, I'm being upfront here. The data is the data, and so that is showing that yes, there has been some normalization from the 2021-2022 surge in driver license exchanges. Conditions change, right? COVID is no longer here. But the interesting thing is the number of people moving in based on those driver license exchange is still higher than in 2019. And in the first quarter alone, you have about 971 more driver license exchanges compared to 2019. And you can still see elevated migration numbers or migration indicator from New York and from California. So a lot of job growth, population growth. Of course, companies are moving in, and where there are people, so retail will thrive. And it's not just the number of people. I think it's across the income spectrum. Of course, you see the high-end retail shops, right? Very high-end because you've got a lot of wealth migration. But at the same time, the jobs that are growing are also service-oriented jobs that are related to the fact that, Miami-Dade is still also very much large and service-oriented. You got a huge tourism industry, hospitality, education also. So lots of those service-oriented jobs, and they're not making 200,000, right? So that's why I think in that retail part of the in the retail analysis, it was very interesting for me to see that the source of growth this time was your community centers. So a lot of it was a community center, the independent store. So lots of those transactions. And I mentioned, I think, Aventura Mall, Hialeah, the Tamiami area. Of course, there's the one that's jewelry center, the Brickell area. And when I saw the picture, I'm like, wow, 4 floors of jewelry here. Speaks to the wealth of the Miami-Dade area. So yeah, that was one of the things that was sold.
That was an interesting deal because the original buyer was having issues doing his original concept. I also think it's super interesting. You mentioned the international, the effect of the international market that had pretty much shut down during COVID, and they're back. And we've talked about it several times on this episode, the effect of the tourism industry, especially the international one, with all of these events, with soccer soccer and Messi, with Formula One, draws that are more of an international, like we always get stuff for the Super Bowl and stuff like that, more local, but this is a big international market for these two events and Art Basel. And I think that now that those are back, all of those people that come and stay here, in addition to affecting our hospitality, they drive up our retail use, right?
Yes, yeah, certainly. And one data that I also love to track, and I think that I mentioned in the report, although I don't think I didn't have a chart for it this time, the number of arrivals at the Miami International Airport, that is coming back up, still a little bit, I think like 500,000 less compared to pre-pandemic level, but that is certainly coming, and I love to track that number. Again, just another indicator of the vibrancy and the demographic of tailwinds that are pushing the Miami-Dade market forward. And I want to mention too, before I forget about this, so we also now have actually, I think with the leasing of Rothschild Bank, and then Santander, Banco Santander from Spain, they also just leased a space. I think they've been in Miami-Dade for quite some time, right? But they leased this space, and they made an announcement that they're in fact going to build this building. So we've got, bankers from Spain, from London, and once you have those, they're gonna, bring more people, bring more business from abroad, because hey, if there's already a Banco Santander and a Rothschild, it's just easy to do trade transactions, investments coming in. So I think that's another area that is going to really bolster the commercial office space in Miami, and just the level of wealth and money and investment coming.
And I want to say, like every great rock band has a greatest hits album, right? And I want to recommend everybody to follow you on LinkedIn, because your posts are incredible. And I think at one of those posts that you created last year was about, interestingly, the level of income of those that were moving into Miami versus those that were leaving Miami. And I think that again, has proven to be quite an indicator of where we are ever since you posted that. I think it was probably a year ago or so. And I would put it as one of your greatest hits, by the way, Gay.
Yeah. Well, see, that information came from the IRS. You're right. So now I'm tracking that. That will come out in June or July. And so come June or July, I'm gonna, I'll go through that data again, give out the numbers. It's about, I think, the average income of people moving in, like 200,000 from New York, and on the net flow of wealth, I think for Miami-Dade, Broward, Palm Beach, I think was $16 billion from that IRS. Yeah, so that's a net flow. So it was even higher, right? A little bit of outflow, but generally $16 billion flowed in.
So let me ask you a question. One of the things that I love about this report, and I know this is the second quarter where you've been really diving into the sold comp data in the commercial sector. I'm loving everything I'm seeing. I know it's only going to get better. But one of the things that I found interesting was your breakdown on the core four was about breaking down construction, right? And so I want to ask you this question. So in the report you mentioned there's very little construction on the retail side of things. Office, there's about 1.4 million square feet under construction. That represents 3.4% of current inventory. And then in industrial, you have a lot of construction, but it only represents about 2.3% of current inventory. And then in multifamily, you have a huge boom of construction that represents 19% of current inventory. So that metric of the percentage of new construction as a percentage of current inventory, how is that useful for the practitioner? How should the practitioner, analyze that data? Because I think that's a metric that you're going to continue to put out there, and it's going to be a really interesting thing to monitor.
Yes, I like that construction metric, because if you think about it, that's really the metric for supply, right? And I think everyone understands that when there's a lot of supply, that puts some kind of a downward pressure on prices. And then if there's little supply, right? So of course there's that prices continue to firm up. And And just for the retail alone, there's not a lot of construction going up. What is it? I'm looking at it now, 22,320 square feet. That's nothing, right? So I think with that, I don't see asking rents going down really significantly. So right now, Miami's asking rent $42 per square foot, one of really the highest. It's even higher than in Boston, based here on this data. So I think that if you're someone, right, who's thinking of investing in the retail market in the Southeast Florida, Miami-Dade market, then of course your first thinking is, well, will I get my rents? Right? What's going to happen to my net operating income, right? And I think, to me, the outlook really is we will continue to see firm and rising rent growth in the retail sector in the Miami-Dade area, just because there's little supply. But at the same time, you have the job growth, you have the migration, you have the rising population growth. There's strong demand relative to supply. So again, as an investor, this is really a healthy market that you can invest in.
And another thing that I think it's interesting that is happening in our marketplace is that you have the redevelopment of, let's say, Southland Mall and what has just been announced with Westland Mall, that they're really not recreating a purely 100% retail center. They want a mixed-use, community-based, very diverse kind of experience. So it's really interesting how that is also going to continue, I think, the trend of not a lot of over construction of retail, which will definitely keep those rates up, and it's going to be very competitive.
When they do development, right? These developers, they like 545 Wynwood, that's in Wynwood, that office space there. The way that they developed the building, the structure of the building, they respected the place, right? So I think that for for a developer to thrive, you got to think of the design, the amenities, because, there's not a lot of land in Miami, and you have to work with the neighborhood. You don't want people saying, no, I don't want this building here. So I think you got to work with the community. You got to respect the character of that community, set up a building, that people can, live, work, enjoy, and become like they feel they belong, and they're really a part of that new structure there. And it's not just a structure to them, it's a place that they love to go on a weekend, and even to work. So I think right now office spaces, right? So I think that's the challenge now. So in a sense, office buildings are having to compete with the work from home environment, right? I mean, if I'm working from home, hey, I can just go grab a coffee, go get up my refrigerator, go get my coffee, at lunch. Maybe I'll work downstairs in my exercise room. And I think so. Even offices, they're trying to compete with that now, putting in a lot of amenities.
Absolutely. Plus, we were just commenting that sometimes the neighborhood becomes the amenity. So when you're developing something new and you're in keeping with what the neighborhood and the composition of the neighborhood, then you complement it and you allow the neighborhood to also be part of the consideration of those that are going to move into that office space, to understand, hey, look at what I have access to beyond just the building.
Yeah, I think that was very true for the development world, Miami World Center. They were very in tune with what was happening to the retail market and also to the needs of the community, right? I was reading about it, and the retail there was supposed to be anchored by Macy's and Bloomingdale. But of course, 2015, 2019, those big boxes, the department stores, they were, having trouble. And so they pivoted, they changed the structure. I should visit that and see what's there. Again, as a developer, you just really have to be more flexible, be more adaptable to the changes in the marketplace. And right now, I think, with the millennials, right? So, they want more of, the experience. I remember I have a daughter. I said, "Oh, I want to go to Macy's and Bloomingdale's." And my daughter went, "That is so old."
Mom, you're so old school. So I love all the granular detail that you gave on retail in this report. But the other thing that I found super interesting, and Fernando and I were talking about it, is how you also broke down the office sales into the different classes. Can you tell us a little bit about what you're seeing in terms of the sales of office?
Yes. Well, first of all, in terms of the market, sales increased here in Coral Gables, Miami, and then Miami Lakes. So those are your major office markets. Of course, in Miami, the Brickell is where a lot of activity is being undertaken. Now, in terms of the breakdown, yeah, this was interesting. Again, it was from our members, right? They said, we want some analysis on the asset classes. And unfortunately, the county doesn't classify office to office properties class A, B, or C. So I thought, yeah, I'll do this by age. And while I think the interesting thing here is that most of the acquisitions or sales that occurred were for buildings that were built in the 1980 to the 1989, or I would say Class C, they're 30-year-old buildings, and then also 2000 to 2009, or your Class B buildings. But a lot of it is really Class C buildings. Of course, why buy a Class C, right? Unless the intention is really to repurpose it. Could be a value add, could be an opportunistic investment. Maybe you'll convert this into a premium asset, but there's really not, again, lots of land in Miami-Dade area. And so I think this trend of acquiring these older buildings and then converting them into your Class A assets is going to be the trend, because right now the demand is really for this premium Class A office buildings, 830 Brickell, those iconic assets. And now, as I said, Santander is even building their own office space. So even I think some of the buildings like 701 and 801 Brickell, I think they're 80s buildings, but they're being repurposed. And so Miami is now I think is a new financial center. And when you want to relocate to Miami, you want to make a big splash, right? You're not going to be relocating in some Class B building, right? That's why everyone wants to be in 830 Brickell. So I think that's why there's a lot of those acquisitions now for the 1980, 89 buildings. Probably great spots there, but they just need to be refurbished. They just need to be remodeled. They just need to be made up to date. Green designation, the LEED designation, maybe strengthening them against climate change, wind and hurricane hazards, things like those. So I think we're going to see still a lot of those acquisitions of the older buildings. Or the other thing too is because they're so valuable. Here's the other thing I was thinking. Maybe they won't be sold there. There won't be any transactions, and the existing owner or the existing developer is just going to, redevelop that area again, right? So I don't know. To me, it doesn't mean that if there were no office sales, that the office market is down. So I don't know how we'll track this, but if they're Class Bs and then they're being remodeled, made up to date, premium Class A office space, that's still a great thing. So I think maybe for the next report, but I think I'll be emphasizing more also the leasing activity.
Yeah.
Well, and you came in on a much lower basis than today. Even with the decrease in sales, we're still higher on a price per square foot than we were pre-pandemic, right? And I think it's interesting because there's a direct correlation too in the Class A office and that income report that you got from the IRS, right? So I'm thinking of Ken Griffin and Citadel, right? In 2022, he bought that space on Brickell and he's building a whole brand new office building, right? So, I think that's going to be an interesting trend to watch. And to your point, as we run out of land, it's going to be buying up, older properties that are,
But you're already tracking the health of the office market, who has been, really nationwide has been the hottest office market in the nation. And, one of the things that I found really interesting is that you began to see a huge increase in asking rents by north of 9% compared to nationwide, which is about 1.8%. That's a huge chasm. And then when you look at the fact that our vacancy factor is at least 5 to 6 percentage points below the national average, that's a huge event. And I'm sure that if we further bifurcate that number, if we drill it down to Class A, Class B, Class C, I'm sure that a big part of those vacancy factors are probably in the Class C buildings, but the Class A buildings are filling up. And there is demand for more product. And it's what Jennifer shared with me, that there's been a flight to quality and people are looking for smaller spaces in nicer places. And that seems to be the case in the market.
Yeah, correct. The Brickell neighborhood, if you go deeper, the vacancy rate there is just 8%.
Wow.
So so there's really a demand for that Class A office space. And as I said, that's why they're converting these Class Bs and Cs buildings, remodeling them. I was looking at this great building, right? 1221 Brickell, glass building. Looking at the write-up about it, that building was built in the early 80s, and then it was remodeled, 2020. You would never think it was a remodel, right, or an upgrade, but it's a great looking building. So and with the companies moving here, right, so they want to make a big splash, right, as I said, when they come to Miami, it's a statement that I am coming here, a lot of development going on, and people coming here, and you got Ken Griffin, you got now what? Microsoft is here. Apple is here. Apple is going to build a new building. As I said, the banks are here. The lawyers, financial companies, they're here. So there's going to be a great demand for those type A classes.
Well, I thought it was super interesting on your office metrics that Miami had the highest percent increase in asking rent year over year than any of the major metros at 9.1%. And we're at $54 a square foot asking rent overall, which obviously those Class A buildings on Brickell are significantly higher. But then I look at the asking rents. We're the highest asking rent behind Midtown New York, which is $78 a square foot, and San Francisco at $69 a square foot. And then number 3 is Miami at $54. So still cheaper, still a bargain. Seriously, if you're coming here as a business and you're moving your headquarters and you're saving in rent in terms of dollars per square foot, in addition to the taxes that you're saving on, the math, it's going back to our friend Delee's cowgirl math, right? It's basic numbers, and you can see just the monetary incentive, not including all of the other incentives of being in an area with great connectivity to every other part of the world outside of Asia, I think. And I think we're getting there with new airlines coming in. So.
Yeah, and I think it's also important to note that, you have 1.3 million per this report under construction, a lot more construction, 3.4%, right? I think from this, Miami actually has one of the highest square feet under construction as a percent of inventory. And, I think that's great because, you also don't want to price yourself out, right? To become very uncompetitive, like as you said, I think $100 in Brickell, maybe for rent, $100 per square foot, and I even heard like $200 per square foot. So, we do want to attract them, but at the same time, you want to have that increased supply so that prices don't just go to stratospheric levels where people will say, well, I love Miami, I'd love to go there, but the math doesn't just work out anymore. So I think it's good that we also have this still supply that is coming, and that new supply will meet the demand so that we don't see this stratospheric rate increases.
So Gay, you've been doing an amazing job of breaking down not only the commercial data, but of course the residential data and just the economic data in our market. And I'm wondering, has there been anything that surprised you about the Miami and South Florida market since you've been tracking it at a more local level?
Yeah, well, what do you call that? The 19, at least for commercial, which is related to residential, this statistic that showed that the units under construction for multifamily is 19% of inventory. Whoa. It's 23 units under construction, adding 19%. That's a lot of inventory, right? So that thing was like, wow, mind blowing to me. And the other thing also is just prices, prices since 2019 in the Miami-Dade County area, home prices, they've gone up, I think, 80% now, something like that. But then we continue to see double-digit price growth. I'm still amazed at that. Personally, I was forecasting, right, home prices will probably slow down to about 7%. But as of February, I'm still seeing like 10% growth. So it just, again, and I was digging at the data. I said, Orlando, not high. Cape Coral, not as high. Tampa, not as high. Like, what is it? And I looked at the job growth. Well, job growth is about the same. Supply was about the same. So what is it? And I noticed that the increase in cash sales in Miami-Dade County has really increased by so much than the other counties. Like it's now about I think 34% are cash sales compared to about 24% in 2019. So again, that story of there's just that wealth flow, that is driving that demand for higher value. I think at least on the residential market, that's still like giving me a wow. The properties are the 1 million plus, about 70% of those are cash sales. Wow. Yeah. Oh, and the other statistic too, if you look at the condos that are being built multifamily, of course we got all this, what do you call them? The branded condos, right? Got the Aston Martin, we've got the Bentley, we've got what? The Porsche. These are like what, 5 million, 20 million homes. And that the brochure says, oh, these are now 80%, 90% leased. It's just wow. Mind blowing, yes. Yeah.
You know what I love about your reporting is when you look at that data that you just brought up about the 19% multifamily, you always give us another way to look at it. And what I love is you followed by explaining that over the last 4 quarters, there's been about 5,400 units that have been absorbed into the market. They've been leased. So you give the perspective that it would take 4 years for this market to absorb these 24,000 units, which again, is a great indication of, hey, this is something that needs to be monitored to see how does that affect rates, how does really affect a vacancy, et cetera. So I love the fact that you're always adding a different perspective so that people really can capture the impact of a number like that.
Yeah, I mean, yeah, you're right. So I am that 19% is something that it's a big number, and of course we're always like, is it going to be a glut, right? Is this thing going to be absorbed? So it looks like with the rent growth, the asking rent is 3.1%. So there's still that, but as you said, it's something that needs to be monitored, absorption of this new development that's coming.
For sure.
Well, and again, going back to the percentage of cash sales, right, that also can explain why Miami and Southeast Florida in general has done so much better, because if you're a cash buyer, the interest rates don't affect you as much, right? Or they don't affect you at all in terms of your purchase decision. So I think that's, connecting all your dots of all the different data that you pull from is very important. So as we wrap up, not everything can be all rosy, right? I mean, we did say that it's started out a little bit slower than we thought overall in terms of sales just because of interest rates. Is there anything that concerns you either on a national level or on a local level that could kind of put the brakes on further on commercial real estate sales moving forward?
So I think interest rate is the thing that concerns me right now, and how that is going to affect the loans that are maturing. We don't see the same problem as New York. The office market is still robust, right? It's something that we need to watch. So that's really the thing that concerns me. And of course, the wealth migration, right? Is it going to continue, to keep coming? And I think there's a demographic tailwind there. We're going to see still retirees, but hey, the last baby boomer is going to retire when? In I think 5 years from now, right?
5 more years. I'm one
Yeah,
of them.
5 more years,
Yeah.
right? I'm thinking about that. And once the baby boomers start retiring.
I'm never retiring. Sorry.
Yes, yeah.
Sorry,
No.
Carlos, never retiring.
Yes, I think interest rates and, just monitoring things, right? I mean, the economy is doing well, but again, things have been slowing down, right? So let's put it this way: the surge that we saw after the pandemic, 2021, 2022, that migration boom has normalized. It is starting to taper. It's still stronger than the pandemic, but I think I'm always watching job growth, migration, and of course interest rates, and to see how all of this is impacting residential and commercial. And so far, the Miami market has been more resilient than nationally. But it's just something we'll have to continue monitoring. And I'm always trying to put these pieces of the puzzle together, right? So I do research on jobs, I do research on migration, I do research on what else? The overall economic conditions, and then just trying to see how these pieces connect, but at the same time also trying to see what makes Miami different. And definitely, as I first mentioned at the beginning of this podcast, it's really the market, right? You've got more cash buyers, as you said, also reiterated, Jennifer. We've got more cash buyers, we've got the wealthier buyers. And that's what makes the Miami market different.
Well, thank you so much for joining us and for all this information. We usually wrap up the end of our episodes with a fun fact. I don't even know if we need any today because you threw so many numbers and so much information out there.
I hope it wasn't a data dump.
No, not at all.
No, because again, I love the connecting of the dots and the flow of information and what something that happens over here means over here. So we love that. We talk about that all the time. But I did come across, we had an event earlier this month with Eventhough where we just invited people out to come and hear what the local market's doing versus national headlines. And one of the slides that Andres showed during his presentation is headlined, "Yes, the global economy is becoming Miami-ish." So that's a new word, Miami-ish. And that's based on Forbes recently ranking Miami ahead of New York and Austin as an emerging tech hub in the U.S.
For me, I'll tell you that. So first of all, Gay, you should know we're huge fans.
Yes.
Right. We are huge fans. And every time that I read your reporting, I always find something interesting in there that leads me to believe that, man, she totally gets it. Because we always preach about the biggest value that we can provide as brokers is to be the hyper-local expert. And I love how in the beginning of your report, you broke down, here are in the order of volume of sales, right? You have retail, industrial, office, and then multifamily. But I love how you further broke it down by area. So you said in the city of Miami, it was office and retail that led the way. If you look at Medley, Opalaca, Miami Gardens, it was industrial. If you look at Aventura, Miami Springs, retail. Florida City had a huge vacant industrial sales that led the way, and then vacant residential in Bar Harbor and in Bay Harbor, and then in Miami Lakes you have office. So I love the fact that you're further breaking it down by minute. You have one of the stats that I loved about it is 32 municipalities in Miami-Dade County, 58 or 59% of them experience an increase in sales volume of commercial core classes. So again, we can't say enough with the work that you're doing, and we're so appreciative that you're here in our market.
And to all of our listeners, we will be posting a link to her commercial insights report on the show notes. But if you absolutely can't wait, don't want to look for it, you can always find her information at miamirealtors.com under commercial, and her reports are there, as well as a bunch of other really interesting information to make you the hyper-local expert. So thank you for joining us.
Thank you so much. I enjoyed this time. Thanks, Fernanda.
Thank you, Jay. You're the best. Appreciate you.